when you look at the charts right now, something feels a little off. Usually, the market works like a seesaw. When people are confident, when they feel good about the economy, they buy stocks, they buy tech, they buy innovation, they want growth, and when they get scared, when they think the system is unstable, they sell those stocks and they run to safety. They buy gold. So logically, stocks and gold should move in opposite directions. When one goes up, the other should go down. But look around you. That isn't what's happening. Stocks are hitting record highs, and at the exact same time, gold is breaking records. Everyone is buying a risk asset, and everyone is buying the safe asset simultaneously. That is the contradiction we need to talk about. Because when the market bets on the boom and insures against the crash at the same time, it's trying to tell us something. At first glance, this looks like greed. It looks like investors just have too much money and they are throwing it at everything. Too much money chasing too few assets. That's the usual explanation. But that doesn't really hold up. Greed is usually specific. If you think the economy is booming, you don't buy gold. Gold just sits there. It doesn't give you dividends. It doesn't have earnings. If you are purely greedy, you ignore gold. The fact that gold is rising alongside stocks suggests something else is going on. It suggests that the money flowing into stocks isn't there because the economy is perfect. It's there because it has nowhere else to go, and the money flowing into gold. That isn't fear of a market crash. It's fear of the money itself. This brings us to the hidden mechanism driving all of this. Debt. We often forget that governments are the biggest players in the economy, and right now, governments have a lot of debt. Historically high levels. When you owe that much money, high interest rates are a disaster. You have to pay more interest just to service the loans you already have. So, the pressure is on to keep interest rates low or to print money to pay the bills. That is good for stocks because cheap money fuels companies. But it is bad for the currency. Every time they print a dollar to pay a debt, the dollar in your pocket becomes worth a little bit less. It's a slow leak. Investors know this, so they take their profits from the stock market, the money that is being inflated by the system, and they move a chunk of it into gold. Gold is the only asset that doesn't care what the government does. You can't print it. You can't dilute it. So they are using it to offset the dilution of the cash. But there is a deeper layer to this. It's not just hedge funds doing this. It's nations. For years, the world's central banks, China, India, Turkey, others have been net sellers of gold. They liked the dollar. They liked U.S. Treasury bonds. They were SOFI. But that has changed. Over the last few years, these banks have started buying gold aggressively. We are talking about thousands of tons. They are exchanging their U.S. bonds for physical metal. Think about that. The people who print the currencies are deciding that gold is a better store of value than someone else's debt. That is a major shift in psychology. They aren't trading it for a profit. They are doing it for a long-term protection. They are reducing their dependence on the dollar system. This is what I mean when I say it's a migration, not a transaction. The smartest money in the world is quietly moving from the paper side of the ledger to the hard asset side. So, where does this leave the average person watching this? We are stuck in the middle. If you just hold cash, you are slowly losing the battle. Inflation acts like a tax. If you only hold stocks, you are exposed to the risk of the system breaking. The market is solving this problem by doing both. It is owning the companies that grow stocks and the metal that preserves value, gold. This creates a strange environment where prices go up, but it doesn't necessarily feel like getting richer because the cost of living is going up too. The winners aren't necessarily the ones with the highest number on their brokerage account. They are the ones who managed to keep their purchasing power intact while the currency devalued. We are watching gold is starting to behave less like a commodity like copper or oil and more like a currency. The old logic was a strong dollar keeps gold down. But what if the dollar isn't as strong as we think? What if the demand for dollars is dropping because the world is losing trust in the long-term stability of the debt? If that trust continues to erode, then this current trend where stocks and gold rise together might not be an anomaly anymore. It might just be the new normal, a system where you have to run just to stay in the same place. The exact numbers on the chart don't really matter. Whether gold hits a specific price or not is just noise. The important part is the direction, and the direction suggests that the world is looking for a firmer place to stand than a paper promise. It's a quiet shift. It happens slowly, but by the time everyone notices the move, the migration is usually already over.